modern trade is doing well and continues to outpace general trade. Similarly, volume growth of premium products is significantly ahead of mass in the market. Price growth in the market continues to tail off as expected and was marginally negative in the current quarter. However, over a 3-year period, it remains substantially high at circa 25% cumulatively. In this challenging backdrop, we delivered a resilient performance. Our underlying volume growth was 2%, underlying sales growth was flat, impacted by negative underlying price growth because of price cuts taken during the year. EBITDA margin at 23.7% improved 10 bps year-on-year. Net profit at rupees 2,519 crores increased 1% year-on-year. Whilst there have been near-term macro challenges, we have been focused on ensuring the fundamentals of our business remain strong. Circa 60% of the business is winning value market share on a MAT basis. More than 75% of our business is gaining penetration, and more than 80% of our business is either growing or maintaining brand power scores. These gains are a result of significantly higher number of superior products, increased A&P investments, and retail coverage expansion. Since 2021, we have gained a substantial 200 bps of corporate market share, and we continue to hold on to almost all of these gains despite heightened competitive intensity. Moving on to performance across the 3 segments, home care and beauty and personal care, which constitutes about 75% of our business, continues to see volume recovery and had mid-single digit underlying volume growth. Consequent to price cuts taken during the year, USG for home care declined marginally and beauty and personal care remained flat. Foods and refreshment, on the other hand, saw a low single-digit decline in UVG, primarily due to the pricing taken in the year to offset impact of higher commodity cost. Consequently, USG was 1%. Margins in all 3 segments remain healthy, with home care at 18%, beauty and personal care at 26%, and foods and refreshment at 19%. We had a busy quarter with many innovations going into the market. Skin barrier care range from Simple, Sunsilk hair serum, Close-Up's new natural range of toothpaste, Connor's Korean K-pop noodles, and Lakme's range of makeup products were some of the key innovations in the quarter. Next, let me elaborate on EBITDA margin delivery for the quarter. At 23.7%, EBITDA has improved 10 bps year-on-year. Gross margin at 50.6% has improved by 400 bps from enhanced mix to premium portfolio and savings from our end-to-end net productivity program. A&P investments at 10.7% is up 270 bps. We have deployed nearly 400 crores higher A&P than December quarter 22 as we continue to step up our investments behind brands and innovations. Employee benefit and other expenses at 16.3% is up 120 bps. This is on account of investments in capabilities, royalty increase, and absence of top-line leverage. Moving on to our 9-month performance, our turnover at rupees 44,886 crores grew 3% year-on-year. EBITDA and profit after tax before exceptional items was up 6% year-on-year. Net profit was up 4%. Looking ahead in the near term, we remain cautiously optimistic. We expect gradual recovery in market demand to continue, aided by increased government spending, recovery in winter crop sowing, and better crop realization. Rural income growth and winter crop yields are key factors that will determine the pace of recovery. If commodity prices continue to remain where they are, we expect our price growth to be marginally negative. Our focus remains on driving competitive volume growth, stepping up investments behind our brands, and maintaining EBITDA margin in a healthy range. We continue to manage our business with agility and take actions to ensure long-term 4G growth which is consistent, competitive, profitable, and responsible. With this, we complete our prepared remarks, and now we take questions.
Thank you, Ritesh. Mangalam, would you like to ask the first question, please?
Yes. I was looking at your numbers, and they're rather weak. For the 4th quarter now, volumes are, in lower single digits here itself. And this at a time when some of the competitors are reporting stronger growth. So I have a 2-part question. One, when do we see significant recovery in volume growth, and when does it, become independent of what the macro environment is? And secondly, gross margins have expanded by around 400 basis points, but all of them have been plowed back into ad spends. you are saying that you expect EBITDA margins to be in a comfortable range. If you could define that range for us, one is, when do we see significant volume recovery? And secondly, what is the EBITDA margin that you are comfortable with?
So if I can, Mangalam, take the first two parts and then maybe ask Ritesh to build on the margin and the EBITDA, the gross margin, reinvestment, and the EBITDA point. So as to sort of respond to your four-part question, is it okay?
Yeah, sure.
So if you disaggregate our growth, and as you said, it has been in low single digits in the last couple of quarters. The fact is that we're coming off a inflation-deflation cycle where clearly the response to the investments and prices is taking some time to come on account of a few macro factors, which we have to also accept as a part of the context we operate the FMCG business in. For instance, the slow recovery in rural, although of course urban continues to be resilient. So we operate within a certain context where we are continuing to be competitive. And as Ritesh mentioned, 60% or thereabouts of our business is still winning market shares. And we are coming off on a very, very high base of market shares of the last 2 years. So we remain strong, competitive, even though the top line numbers are what they are optically. As far as volumes are concerned, if you disaggregate our volumes by our three businesses, our home care, beauty and personal care businesses are growing in mid-single digits, which is our second quarter in a row. So where we have taken prices down, we already start to see a price response to volume, and volumes are coming back, including, of course, being helped by the slow recovery in rural. On food and refreshment is where we have negative volumes. That brings down the total number. And that is largely because a lot of that, the categories we operate in, food and refreshments, still have faced high levels of inflation. To name an example, coffee, even on HFD. And in tea, we are seeing some downgradation. So it's still coming on the back of high prices, although the increase in prices is beginning to sort of narrow and stop. So we do expect over a period of time this will lap. But as we speak, food and refreshment is where we see the volume drag, although the heartening fact is that we remain very competitive on value share across all our big categories in food and refreshment. So that is something that gives me quite a lot of confidence that what we're doing fundamentally are absolutely the right things. We are investing behind our brands. Our brand power is strong. Advertising, which had come down over the last several years of high inflation, is back. We are at very competitive levels of investment. Brands have good product quality, and I feel that our distribution and operational grip is tight. So we are going to come out stronger from this inflation-deflation cycle. And all we are doing around building our business for the future, such as investing in beauty care, capability, and all of that is going to basically pay off in good stead. So I feel quite optimistic that all of these investments are in the right places, and we will see, as macros tend to improve, some turn in volumes as well. I would ask Ritesh then now to complete the question on the margin and how exactly the shape of investments that we're currently choosing.
Sure. And Mgmt, just to further build on the few more elements. So as Rohit mentioned, the home and personal care and beauty and the entire business put together has grown mid-single digit. Remember, this is 3/4 of our business. So already 75% of the business has registered mid-single digit volume growth. And it's the foods and refreshment, which is the quarter of the business, which Rohit explained, given commodity inflation, given a very different commodity cycle, which is where we've seen low single digit volume decline. And also, I want to call out the premium categories. If you look at beauty premium categories, if I look at the plus range within Horlicks, again, the premium part of HFD. If I look at newer formats, mask, serum. If I look at innovations like mayonnaise peanut butter. So these parts of the businesses are already showing double-digit volume momentum. So there are parts of the business which have shown momentum very different. And of course, certain parts of the business are dependent upon the realities of inflation, which is different cycle compared to the rest of the business. On a 2-year basis, the point I was making earlier, when markets are growing on volume now, it was declining in the base period. On a 2-year basis, FMCG is 2% CAGR growth in this quarter. Previous quarter, same number was 1%. So we have seen the CAGR 2-year moving from 1 to 2. And what has changed is 1 to 2 is rural, which same period in the previous quarter on a 2-year CAGR was -1. It's +1. So rural has added in last 1 quarter that momentum, which has gone from 1% cumulative CAGR to 2%. And coming back to your margin question, the point we have maintained that our focus remains on driving gross margin. First, we got our gross margin improved, and we brought it to the levels of pre-high inflation. The second job that we have, so remember pre-inflation, we had roughly 52% margin, gross margin, which we brought back. And our job now is to go back to pre-COVID levels, where we had 54% gross margin. And hence, driving gross margin will continue to be a tremendously important focus for us. But equally, as Rohit mentioned, dialing up investments, not only in advertising, sales promotion, but also in product superiority, also in capability, remains squarely important, and leaning in as required on price and promotion, the way we have done in this quarter. When you saw in this quarter, our sequential margins for beauty and personal care and home care declined a little bit compared to the previous quarter, because we leaned in with product investments, we leaned in with price and promotion to ensure fuller volume recovery. So there are those puts and takes always in the P&L, and where our margins are today at 23.7, they are healthy margin. And we have maintained that the levels of margin that we have today, we are happy with this margin. Our single-minded focus is to ensure fuller volume recovery and keep dialing up growth.
What, in your assessment, would lead to growth in volumes once again from a macro standpoint? By when do you see recovery in rural?
Yeah, so there are two factors we called out which will really determine the pace of recovery. Number one is the rural income growth, and we know that that's an area which is important for us to see those markers. And second is the winter yield. In our view, those two elements should determine the pace of recovery as far as rural is concerned. And as you mentioned, that overall there are categories like F&R, which today we have lower single-digit volume decline because of commodity inflation. Now, the good news again is where we are today, we are seeing commodity inflation in food categories also moderating, which means now, like the balance 3 quarters of the business, even this part of the business then should start seeing year-on-year price inflation getting moderated, and then should help further recovery of volumes in that portion of the business as well. So those, I would say, are the two large elements which should determine sequential further recovery of volume from where we are today.
And just to follow up on that, the points that are within our control are invest in market development, sales, which have got the future spaces where we see consumer upgrading. We see high growth there already at about roughly 2 or 2.5 times our average. Premiumization, we see again, those segments are growing very, very fast. Innovations both in value and feature. So the job we as market developers and market makers is essentially to lean in on those vectors. And we see high level of productivity of doing that. And all of the investments and moves that you're seeing from us are essentially to put more focus around market development, premiumization, and innovation.
Thank you. Sesa, would you like to ask the next question?
Yes, hi. In terms of the material inflation, I do understand that there has been inflation, and you did mention about that. But given that food and refreshment is a category, and that too in a festive quarter, we have seen a low single-digit volume growth. Could you quantify what is the material inflation that you have seen in Q3? And also, is it some kind of a structural slowdown that we are seeing?
See, on inflation within foods and commodities, what really impacted us was fresh milk, which impacts the impact on Horlicks, both skim milk powder over a long-term period, and fresh milk, because when you consume a cup of Horlicks, apart from putting Horlicks, you also put a cup of milk into it. Within food commodities, coffee and sugar have seen inflation. In fact, coffee, when you look at last 2 years, cumulatively is a 70% inflation. And which is why, as we have taken price increases, not to the peak of inflation, but we have taken price increases to respond to this high inflation. We have seen growth in terms of business. So our coffee business grows in double digit, but it has led to impacting of volumes, and volumes have declined. Similar has been the impact on HFD as well, where we have seen growth, but volumes have declined. That is the overall impact of commodity, which I spoke about in terms of F&R business for us. Now, skim milk powder has started to moderate compared to where it was, and year on year now we see, in fact, small decrease. Tea commodity overall, we had spoken earlier, has moderated for last 2 years. In fact, we've seen deflation in tea commodity, but there the market is downgrading to plainer teas, to the loose teas. So there's a mix of commodity inflation and downgradation, which has impacted. Now, as we move forward, the point I was making earlier, inflation has moderated in foods commodity as well now. And hence, going forward, if at all this situation continues of commodity, this moderation will help volume recovery. The way we have seen in 3 quarters of the business, home care and beauty and personal care, where we are now seeing in our business mid-single digit volume recovery because there's a meaningful correction which have happened in commodity cost. That has helped us to take prices down, and we have seen volume recovery. That should also happen in times to come for the foods and refreshment business as well.
Right. So how many more months before we can see a material uptick in volumes? Is there a projection that you would like to put out?
No, I mentioned that the overall, apart from commodity impact, the point that Rohit and we mentioned earlier, the pace of recovery will be dependent upon rural income growth. It will depend upon how the yields from the winter crop comes out. Those are factors which will end up determining the pace of recovery. But we know that the point Rohit was mentioning earlier, the premium portfolio, the investments that we are leaning in, the increased government spending, the better recovery which has happened of the winter crop sowing, there are those factors which should help overall operating environment to keep improving.
Right. While you did speak about the macro part of it, but I would also like to know there are a lot of issues with the general trade, right? There has been a slowdown in the general trade, and you did take a lot of action in terms of revising your margin structure. Can you tell us that how is it going? Do you what kind of initiatives you are taking to improve your general trade business?
So let me take that the question specifically on general trade. Let's first start by saying that the general trade or traditional trade or distributor trade, as we call it, is a very, very important part of our business. We've had long-standing strengths in that business. It's under 70% of our sales, and we consider it extremely important. We've been investing in our general trade capability for many, many years. We have invested in technology, capability, processes. We have a distributive inclusive model and a distributive progressive model. And we have always been working on making sure our distribution system and our distributors are contemporary and are future fit, because we believe this is absolutely an important core of how Hindustan Unilever operates. It's a competitive mode. As a consequence of that, we have been wanting to, in certainly larger cities, have a system that incentivizes for higher earning our distributors to sell to more stores, deliver the next day, make sure that they sell market development, assortment, things that consumers are not willing to buy, and make sure they don't get compromised in the selling systems. And all of this was wrapped up in this very progressive, future-ready model that was tested for almost an entire year. And then, given the fact that we found a very favorable response, we also know that the distributors actually increased the level of earnings. We've then extended that to the top 100 cities, where it's been 3 months in operation. We have good signs. So it's just a very positive win-win for our distributors. It's a very positive win-win for our customers, the Kirana merchants, who are our bedrock of our economy. And it's also a very important win-win for the company, because this way we get more growth. So all in all, I feel it's the right thing to do, and it should be virtuous and healthy for all people concerned in this particular value chain. So that's really my comment on the margin structure, if it helps clarify where we are coming from.
Thank you, Rohit. Vinny, would you like to ask the next question?
I think you're on mute.
You're on mute.
Can you hear me now? Hi, sorry. Good afternoon, gentlemen. So I just wanted to know a couple of things. One, in terms of the regional players, we've been seeing that competition that has been increasing. So has that still continued from regional players? And specifically, in which segments are you seeing those higher competition? Also, in terms of the detergent segment, is that also seeing high competition on that front? And in terms of, you mentioned in the retail milk prices and in the inflation on that front, Rohit. So HFD segment, when could we start expecting to see that recovery? Because that's been a bit subdued for at least 3-4 quarters now.
Yeah, let me just comment on the regional players. And, this is a very exciting market, and we've always had regional players across length and breadth of our country. During inflation and tough times, consumers tend to prefer big brands, and a lot of the supply chain gets more and more challenging. A lot of the regional local players tend to leave the market, especially in categories where there's very low entry-exit barriers, or segments with the low entry-exit barriers. So specifically, we've seen that happening in detergent bars, somewhat at lesser extent in personal wash, and a little bit more moderately in tea. Having said that, what really has happened for us as a company is that over the last 2 years, as a result of this inflation and now deflation cycle, we have ended up getting a very, very solid 200 basis points of market share. Despite some of the share going back to the regional local players, we're holding around the same levels. And I believe that much of this transition to, let's call it, the next phase of the market has already broadly happened. We've adjusted prices where we needed to, or we've not adjusted prices where we chose not to. And by and large, we are now reaching on the other side of this deflation. And we believe things will start to normalize insofar as the competitive set is concerned. And we would be still at a higher market share on an absolute corporate level than we were going into this in early, sort of somewhere in 2021. So that's to give you a flavor of the regional players and how it impacts our business. The impact is mainly on detergent bars and in some cases on rest of the laundry and a little bit of tea and some to some degree in soaps. I think that's really the explanation on this phenomenon. As far as HFD is concerned, health functional drinks, an exciting category, primed for growth because it's underserved. Penetrations are still low, even in the south and the east where we have big businesses. In HFD, we have over the last year or two that we've been focusing on making this business stronger. We have gained 600 basis points of penetration, so more users. We've been able to establish a very strong top tier with our light and our plus ranges, both of which are doing quite well and are sizable now. And we see a very, very long runway for growth in the premium end. Functional, pharma-specific type, clinically proven propositions. We do have now a situation where milk prices have softened, and we expect that this would be a lot more amenable to the HFD growth going forwards. Of course, we've gained market shares quite handsomely. So I believe we are in a very, very strong position, even from point of profitability, to now take this business to the next level, where our focus is going to be to, of course, uptrade where there's tailwind and increase the level of relevance for the Horlicks core, because the key job is to actually increase consumption. And that's why you see us taking the focus on sharpness as a benefit. You see us focusing on occasions like exams and monsoons where the need for the products are higher. So we believe we are on a long trajectory of investing behind this business, and there's a huge amounts of opportunities and degrees of growth still left in the HFD business, which is exactly the reason why we got into this.
Nupur, would you like to ask the next? Vinny will come back to you.
Okay.
Nupur, would you like to ask the next question?
Yes, sir. Hi, good evening, sir.
Hi.
Hi. सर मेरा क्वेश्चन थोड़ा ऑपरेशनल परफॉर्मेंस पे आपने डिस्कस किया, डिमांड एंड एवरीथिंग, सो आई हैव अ डिफरेंट क्वेश्चन little related to macro events that's going to happen in next few days. कोई भी नया इकोनॉमी डेवलप होती है तो एफएमसीजी सेगमेंट में हम डिमांड बूस्ट देखते हैं. अयोध्या इज अ बिग इवेंट एंड देन आल्सो वी हैव बजट कमिंग अप. तो सर दोनों ही चीजों पे आपकी एक्सपेक्टेशन कैसी है, और बजट को लेकर एफएमसीजी सेक्टर के लिए आपकी एक्सपेक्टेशन क्या है?
आदि ये सवाल बेहतर रहेगा कि रितेश ही आंसर करें, तो मैं रितेश को रिक्वेस्ट कर रहा हूं जवाब.
So on Ayodhya, what we had done a year ago, we appointed our own distributor in that geography, and we have put our entire portfolio in Ayodhya region. For example, every state we have a different portfolio. In UP, we have a very different portfolio we sell compared to Tamil Nadu. But given the fact that this will have a massive congregation of Indians from across the country, we have increased our portfolio that is present in that part of the country. So ensure that when consumers come from different part of the country, they do get the portfolio that they want to see and use. Equally, we do have our own playbook for such large congregation, be it Kumbh Mela, be it Uttarakhand, and we have deployed our playbook. So all three things put together, a dialing up of the infrastructure, a higher assortment which is present, and deploying our entire activation playbook put together, we should be able to capture and bring our business alive as we start capturing the opportunity which we have for business using the occasion.
On the budget, asking on budget if there is specific.
On budget, of course, is very. What's more important for us? I think the macro level, as I mentioned earlier, there are two things important for us: rural income growth, number one, and number two, of course, weather dependent, which is monsoon, crop, yield. In our view, those are the two factors which will determine the pace of recovery. And a lot of investments are already gone in by government on capex. the point that we mentioned, and it does have a cascading ripple effect in terms of improving the jobs and improving ultimately the non-farm income of rural. And we are seeing early signs of non-farm income improving for rural, and hence continued investment in the rural area will help us to ensure that the recovery happens of the rural demand. So I would say that would be expectation.
Thank you, Ritesh. Vinny, your final question?
Hi. Yeah, I just wanted to know in terms of, the premium segment, especially in beauty and personal care, if you could just give me an indication of how that is doing.
Sure, I'll just give you really my passion for this category and then speak to request Ritesh to add some of the flesh behind that narrative. So we remain very, very excited about beauty and personal care. And as you know that we've announced that we are going to be focusing on these two as two separate divisions because of, they have different competitive sets, different business models, different innovation rhythms, and what they therefore require are two very different kinds of operating models. So we are seeing on beauty care, especially, where we have very, very strong market positions, a huge headway for premiumization, renovation. Many of our brands, such as Lakme and Pond's, are doing exceedingly well, both in terms of volume value. And of course, this business comes as accretive to overall HUL margins. Even Glow & Lovely has turned around, and we see Glow & Lovely seeing positive quarters of growth going forwards. So we are going to fill up the portfolio, especially in the beauty care, to make sure that it tends to offer offerings or brands at all relevant price points and demand spaces. And we are investing behind that. Much of the investment you see in A&P is also going behind beauty and well-being, which is, of course, a more accretive part of our business to invest in. So I would like maybe Ritesh to fill in some more specifics on some of the categories or anything you would like to add, Ritesh.
Sure. So, Vinny, if I just give a little more color to the performance in the quarter on beauty and well-being, and let me speak on two categories, hair care and skin care. Hair care, we have seen double-digit volume and value growth, so a very good all-round performance of hair care business. Skin care business, I would want to speak about in three different portions. Winter, I mentioned earlier as part of the commentary, has been less severe and has been delayed. That has impacted our winter portfolio, which has declined in the quarter. The non-winter portfolio, again, I will segment into two parts, the mass skincare and the premium skincare. The mass skincare business has shown good growth, and it has shown mid-single digit volume growth. And if I talk about the premium skincare business, there, the point I was making earlier, we have seen high single digit to double digit growth momentum, be it on serums or be it on our premium brands that we have, or be the new formats that we end up selling. So we have seen a momentum which is very strong in the premium skincare business. So that's what are different, I would say, realities of overall beauty business in the quarter.
Thank you. Thank you, everyone, for joining this call. Have a great day ahead. Thank you.
Thank you. Thank you.